Hello, friends. If you own a home in Canada right now, or you are a Canadian senior planning to keep your home through retirement, I need you to stay with me until the end of this video because what is coming in June 2026 could affect your property, your rental income, your tax deductions, your insurance, and even the way you are allowed to use your own home. And yes, I know the title sounds strong. Total ban for Canadian homeowners, effective June 2026. But let me explain exactly what that means, because this is not about the government banning every Canadian from owning a home. That is not what this is. The real issue is much more specific, and for many homeowners, much more dangerous. Across Canada, governments are tightening the rules around short-term rentals, vacant homes, underused properties, basement units, secondary suites, rental permits, municipal licensing, and CRA reporting. And starting in June 2026, many homeowners may find themselves facing a harsh reality. The old way of using a home for extra income may no longer be allowed. The old way of renting a room, listing a basement, keeping a property empty, or claiming expenses on a short-term rental may no longer be safe. And if you do not check your rules before June 2026, you could lose deductions, face penalties, receive a municipal fine, trigger CRA attention, or discover that your insurance will not protect you when something goes wrong. This is why I am calling this a total ban warning for Canadian homeowners. Because for some homeowners, the activity itself may be banned in their municipality. For others, the activity may still be legal, but only if you register, get a license, follow local rules, report income properly, and keep your property compliant. And if you ignore that difference, it can cost you thousands. Let's start with the biggest group affected, homeowners using their property as a short-term rental. If you rent out your home, basement, condo, cottage, laneway suite, or second property for short stays, you need to pay very close attention. In many Canadian cities, short-term rentals are no longer treated casually. Municipalities want registration. Some require a license. Some only allow short-term rentals in your principal residence. Some restrict entire home rentals. Some buildings prohibit them completely. Some cities are cracking down because of housing shortages. And here is where CRA becomes important. If your short-term rental is not compliant with local rules, CRA can deny certain expense deductions. That means the money you spent on mortgage interest, repairs, cleaning, insurance, condo fees, utilities, maintenance, and platform fees may not be deductible the way you expected. Think about that carefully. A homeowner may still collect rental income, but if the rental is non-compliant, they may lose the ability to deduct expenses against that income. That can turn what looked like a profitable side income into a tax problem. This is where many Canadian homeowners get blindsided. They think, I listed my property online, I earned some income, I will just report the income and deduct my expenses. But if the city or province says your short-term rental was not allowed, or if you failed to get the required permit, license, or registration, CRA may treat those expenses differently. That is why June 2026 matters. By this point, many cities and provinces are no longer giving homeowners the benefit of the doubt. The rules are already in place in many areas, and enforcement is becoming stronger. If your property is not compliant before the summer rental season, you may be walking straight into a tax and bylaw problem. Now let's talk about seniors and retirees. Many Canadian seniors use their home as part of their retirement plan. Some rent out a basement room to help pay property taxes. Some rent a cottage during the summer. Some keep a second property in the family. Some use rental income to cover mortgage payments, utilities, insurance, repairs, groceries, and medication costs. But the problem is that rental income can also affect your taxes, your GIS, your CRA benefits, and your overall retirement planning. If you receive GIS, rental income may matter. If you receive income-tested benefits, extra income can change your eligibility. If you own a property that is vacant or underused, certain taxes or municipal rules may apply depending on your location and ownership structure. So this is not just a housing issue, this is a retirement income issue, this is a CRA issue, this is a Service Canada issue, and for seniors living on fixed income, this can become very serious very quickly. Now let's move to the second group affected, homeowners with vacant or underused properties. Canada has been pushing harder against empty homes and underused housing because of the housing shortage. At the federal level, there has been the underused housing tax, and at the provincial and municipal level, some areas have their own vacancy taxes or empty homes taxes. Not every Canadian homeowner is affected the same way. Many individual Canadian citizens and permanent residents who own their main home may be excluded from certain federal filing requirements, but that does not mean everyone is safe. If your property is owned through a corporation, a trust, a partnership, a non-resident owner, or a more complicated family structure, you must be careful. A property that looks normal to you may look different to CRA. And if you ignore a filing requirement, the penalty can be painful. This is where people get caught. They say it is just a family property. They say nobody told me I had to file. They say the house is not rented, so there is no income. But taxes and filings are not always based only on whether you earned income. Sometimes the requirement depends on who owns the property, how it is structured, whether it is vacant, whether it qualifies for an exemption, and whether the correct forms were filed on time. This is why homeowners must check before June 2026, because by the time CRA sends a notice, you may already be late. Now let's talk about the third group, homeowners with basement apartments, secondary suites, or rental rooms. Across Canada, more people are using basement units, garden suites, laneway homes, in-law suites, and room rentals to survive rising costs. And for many people, this is completely legal when done properly. But there is a major warning. Legal does not mean automatic. Your city may require permits. Your unit may need safety standards. You may need proper exits, fire separation, smoke alarms, electrical compliance, zoning permission, parking rules, and rental registration. If you rent out a unit that does not meet local rules, you could face fines. You could be ordered to stop renting. You could run into insurance problems. And if there is a fire, flood, injury, or tenant dispute, the cost could be devastating. This is especially important for seniors who rent out part of their home to help pay bills. You may think you are doing something simple. You may think, it is my house, I can rent a room. But municipalities may not see it that way, and insurance companies may not see it that way either. If you are renting any part of your home, call your municipality and ask whether your rental unit is legal. Call your insurance company and ask whether your policy covers rental activity, and speak with a tax professional about reporting rental income correctly. Do not wait until something happens. Now let's discuss the fourth group. Homeowners claiming tax deductions without proper records. This is a huge issue. If you earn rental income, CRA expects you to report it. If you claim expenses, CRA expects records. Receipts, invoices, bank statements, lease agreements, rental dates, advertising records, repair records, mortgage interest details, property tax bills, utility bills, insurance documents. These things matter. But many homeowners are casual about it. They collect rent through e-transfer. They pay repairs in cash. They keep no proper records. They mix personal and rental expenses. They claim large deductions without proof. That is risky. In 2026, CRA has more data than ever. Rental platforms, banking activity, property records, tax filings, and municipal licensing can all create a clearer picture. If CRA reviews your rental income and your records are weak, deductions can be denied. And if deductions are denied, your taxable income can rise. That can affect your tax bill. It can affect GST/HST related credits. It can affect income tested benefits. For seniors, it may even affect GIS calculations. So if you are a Canadian homeowner earning any kind of rental income, you need to treat it seriously. Keep records. Report income. Do not guess. Do not copy what a neighbor does. Your situation may be different. Now let's talk about the fifth and most emotional part, property taxes. Many Canadian homeowners, especially seniors, are struggling with property tax increases. Your income may be fixed, but your property tax bill keeps rising. Your home value may look high on paper, but that does not mean you have extra cash in your bank account. Some provinces and municipalities offer senior property tax deferrals, rebates, grants, or relief programs, but many homeowners never apply. That is another silent loss. You may be paying the full amount when help exists, but the warning is this: do not ignore property tax bills. If you fall behind, municipalities have collection powers, penalties can build interest can build. In extreme cases, unpaid property taxes can become a serious legal issue against the property. So while the government may offer help, you must apply before the situation becomes dangerous. Call your municipality. Ask about senior property tax relief. Ask about deferrals. Ask about low-income homeowner programs. Ask about disability-related supports. Ask about provincial credits. One phone call can make a major difference. Now let me make this clear. This June 2026 homeowner warning does not mean every Canadian homeowner is in trouble. If you live in your own home, do not rent it, do not leave it vacant, do not use it as a short-term rental, and keep your taxes and insurance current. You may have very little to worry about. But if you are doing any of the following, you need to act immediately. If you rent your property short-term, check your municipal rules. If you rent a basement unit, check your permits. If you keep a property vacant, check vacancy tax rules. If your property is owned through a corporation, trust, or partnership, check UHT and filing rules. If you claim rental expenses, keep records. If you are a senior struggling with property tax, ask about deferrals or grants. If you receive GIS, understand that rental income may affect your benefit. This is the real warning. The government does not need to ban home ownership to create problems for homeowners. Sometimes all it takes is one missed form, one unlicensed rental, one outdated assumption, one denied deduction, or one municipal rule you never checked. That is how people lose money. Now here is exactly what I want you to do before June 2026. First, call your municipality and ask whether short-term rentals are allowed at your address. Second, ask if you need a license, permit, registration, inspection, or renewal. Third, if you rent a basement, room, suite, cottage, condo, or laneway home, confirm whether it is legal under local rules. Fourth, call your insurance company and ask whether your policy covers rental activity. Fifth, log into CRA My Account and make sure your tax filings are current. Sixth, if you own property through a corporation, trust, partnership, or non-resident structure, ask a tax professional whether any special filing applies. Seventh, if you are a senior homeowner, call your municipality and ask about property tax relief, deferral, rebate, or grant programs. Eighth, if you receive GIS, contact Service Canada and ask how rental income may affect your benefit. The Service Canada number for CPP, OAS, and GIS is 1-8002-779-914. For CRA individual tax questions, call 1-8009-598281. And for general federal information, you can call 1-8000-CANADA at 1-8006-226-232. Now, please be careful with scams. Whenever homeowners hear words like ban, tax, deadline, CRA, penalty, or new rule, scammers take advantage. They may call pretending to be CRA. They may claim your home is being banned. They may ask for payment to register your property. They may send fake links. Do not click random links. Do not give your SIN over the phone to a stranger. Do not send money to someone threatening you. Use official websites, official phone numbers, your municipality, CRA, Service Canada, and qualified professionals. So let's bring everything together. The total ban warning for Canadian homeowners effective June 2026 is really about one thing: compliance. Short-term rentals may be banned or restricted in your area. Non-compliant rental expenses may be denied by CRA. Vacant and underused homes may trigger tax rules depending on ownership and location. Illegal basement units can bring fines and insurance risks. Rental income can affect taxes and benefits. Property tax relief may exist, but only if you apply. This is not something to ignore. If your home is your biggest asset, protect it. If your home is part of your retirement plan, protect it. If rental income helps you survive, protect it. If you are a senior homeowner, do not wait until June 2026 to discover that a rule changed months ago and nobody told you clearly. Take action now. Check your city rules. Check CRA. Check Service Canada. Check your insurance. Check your property tax options. And if this video helped you, subscribe to the channel, share it with another Canadian homeowner, and comment your province below. Ontario, Alberta, British Columbia, Saskatchewan, Manitoba, Nova Scotia, New Brunswick, or Newfoundland and Labrador, because these rules can depend heavily on where you live. This is Andrew. Stay careful, stay informed, and never assume your home is protected until you check the rules yourself.